Welcome everybody to our webinar on ESOPs.
The conference has been unmuted.
Architectural and engineering firms. I've unmuted everybody briefly. Want to make sure that everybody can hear clearly.
Yes.
Folks here. I'm now going to mute everybody but myself. If you have questions during the course of the presentation, you'll have the ability to.
The conference has been muted.
In your window, and I will try and take questions as they occur. And please feel free to interrupt and ask appropriate questions. And what we're going to do this morning is we're going to talk about the ESOP approach to liquidity and succession, particularly from the perspective of an architectural engineering firm, and generally really from the point of view of professional service firms, which have some unique attributes as they look at and consider the general problems of liquidity and succession and how to use ESOPs as an approach to deal with it. And in order to understand whether and how ESOPs make sense, we have to start by understanding the basic problem. Basic problem is all companies that are privately held have some form of a liquidity challenge, which is to say none of us lives forever. Most of us would like to receive at some point fair value for a privately held company we own. We can't take our companies down the street to Merrill Lynch or Morgan Stanley and say, great run, sell them at the market. And so if we want a liquidity option, we need to do something planned and organized. And so therefore, we have to arrange a transaction. Someone has asked if the slides are available. They should be on your screen at the bottom if you hit the button slideshow, if anybody's having trouble viewing them. So we then start with what are some of the unique aspects of professional service firms generally. And certainly we start out with the idea that we have a low fixed asset base. Proverbially, the assets walk out the door every night. We may have some lovely desk chairs, office furniture, maybe some software and computers, but not anything that is readily sold. So the value of most professional service firms lies in their ability to generate cash flow, not the underlying asset base. Secondly, of course, we have a little bit less of a vibrant M&A market in the world of professional service firms, and that's because it's always a little less clear what the synergies are, who the buyers are, and since most of the buyers out there, be they strategic or financial, are buyers who would like to leverage their purchase using, in some respects, borrowed money, our low asset base makes that harder for buyers to emerge. Next problem or next issue we have is we have a higher socioeconomic status workforce. We have, by and large, educated people providing professional services as a significant part of our base. And these are folks, by and large, with mixture of higher expectations for compensation, for ownership, and for status, and probably also more mobility, the ability to go work for other similar firms elsewhere doing the same thing. And then finally, of course, we have, and we'll talk a little bit later, we have the impact of state law corporate issues, which is to say most professional firms are organized as some form of a corporation or limited liability company, but we have many various restrictions in different states as to who can have an ownership interest in a firm providing professional services, and they range from states in which there are no effective restrictions to states in which the only permitted owners are licensed practitioners of the particular field. What are folks trying to achieve when they look at liquidity and succession? First and foremost, they're thinking about how big is the check and how much do I get to keep. And there are people who can do their liquidity and succession planning on a calculator. It's simply a matter of dollars. But for a lot of folks, it's not only about the absolute raw dollars, it's also about the timing. And particularly in professional service firms, we're often talking about shareholders who are also key professionals, entrepreneurs involved with the day-to-day operation of the enterprise and participating in the day-to-day customer client functions, delivery of services, etc. And so when we're talking to people about their ownership interest, we're also talking to them about their career, their work in their lives, as well as their financial interests. And so you've got the conflicting sets of issues of wanting liquidity, wanting a succession plan, perhaps wanting to remain involved in the firm actively as a professional or an executive, perhaps wanting to become less involved and not having a clear path to do so. And then the other goals, of course, of diversifying individual wealth and dealing with what eventually happens to the firm. And as I said, some folks decide these things, on a sheet of paper with numbers or with a calculator. For a lot of folks, particularly again in firms that provide a service and have a tie to an industry and a client base and a set of key people, there's another set of concerns out there that I label broadly as legacy, which are about what's going to happen to the company, who's going to benefit from it, how is it going to be perpetuated, and a whole bunch of other intangible kinds of things. And what are people worrying about? Obviously, family members in the business potentially, if there are kids involved somewhere along, continuity of the business and its operations, making sure that the people who have built it continue to be able to work there, perhaps preservation of name, role in a community, and so forth. How does one get out at an appropriate pace, which is the mixture of, for some companies, the challenge is finding qualified successors, and for others, the challenge is holding off those successors from jumping in too fully until one's good and ready to leave. And this is, of course, a delicate balance here. We have, of course, the issues of rewarding key people. And how do we have a sale that doesn't leave us on the hook forever? Because again, and particularly in a lot of professional service firms, there's a lot of transfers that are going on either internally or externally where the sellers are on the hook with a mixture of liability, professional liability, holding notes, et cetera, et cetera. And these are all issues that people worry about in the planning process. And so with that, we can take a quick look at the matrix of alternatives. What do people think about when they're thinking about liquidity and succession? And there's the world of external buyers, aka other people's money, and they can be strategic buyers, people in a similar industry or people that see you not as you are, but as you might be in combination with their resources. And of course, those strategic buyers are out there, but probably a little less prevalent in the A&E world. There are financial buyers, people who are going to buy firms, these are now primarily private equity buyers and the like, who are buying to purchase streams of cash flows and expected future returns with the idea of reselling the firm in 5 to 7 years. And while there are some reasonable number of strategic buyers out in the A&E world, there are actually fairly few financial buyers, again, because financial buyers are usually getting their returns using lots of leverage, and A&E firms are fairly more difficult to leverage than other firms that have higher asset bases. Finally, IPOs used to be 10, 15 years ago, any high-growth firm would talk about, well, we're going to exit by doing an IPO. I haven't had people talk about that now in quite a number of years, as the thresholds for doing so have really risen, to companies that really have at least $500 million of revenues, and I'm not sure we have anybody who would fit that description on our call today. And from there we go to the world of internal buyers. Internal buyers are people who have some connection with the company already, and basically are going to use the company's cash flow in some way, shape, or form to buy a larger interest. And if we take a conceptual approach to these internal buyouts, the technique is company cash flows to accomplish the purchase of stock, and the mechanics can be anything from diversion of profit sharing or compensation bonuses, salary continuation agreements, or leveraged purchases. I would say the most common thing we've seen around what I've always called the engineer's succession plan has been, well, let's pay good compensation bonuses to our key people, and let's have those key people turn around and use those bonuses to buy stock from the founders. And we'll talk in a little bit why that doesn't really work terribly well, but it's still a very prevalent idea. And we start with the, I guess with a little conceptual approach here, which is the measurement of cash flow that's available in a company is usually considered to be EBITDA, earnings before interest, taxes, depreciation, amortization. And there's really only 4 key places that EBITDA can go. First, in our top left quadrant here, EBITDA can certainly go for capital expenditures, buying things to help keep the business or grow it. Can go into the working capital cycle. As we grow, we fund more receivables, etc. Can do acquisitions, or we can make other kinds of investments for continuation or growth, things that we don't capitalize that are really CapEx-like, or investments in R&D, new areas, opening new offices, all of the ways we invest back in the company. Second, and ever popular idea of what can happen to cash flow is we can give it to the shareholders. We can make distributions, we can pay dividends, we can pay compensation bonuses. We're only limited sometimes by our imaginations and how shareholders can benefit from company cash flow by getting it out. Thirdly, in the bottom left, for the most part, inevitably, a portion of our cash flow is going to go to taxes based on our reported taxable income. We're typically going to be handing the feds 35% of our reportable taxable income, and our states and municipalities may be taking a piece as well. And really the fourth idea here, which is the idea of these internal buyouts, is we can use a portion of the cash flow for what I call capital share transactions. And this can be any use by any internal buyer of the cash flow of the company to pay the former shareholders for their share ownership. And if we take a quick gander down the world of internal buyers, we start out with family businesses, and these are usually ideological rather than finance decisions. These are typically have issues around the tension between liquidity and reward for the older generation and opportunity for the succeeding generation. And you really end up with one of 2 rhythms in various degrees, which is either something that looks like a management or partner buyout where we use current company cash flows to finance a purchase of stock, or some other way of getting money to the existing shareholders, and intergenerational wealth transfer, which is another way of saying we give some of the ownership to the kids. But basically, companies that have a family business ideology do this. Companies that don't. It's not particularly driven by any rational analysis in my experience. We then get to the world of management buyouts, something that's been used commonly in A&E firms, and particularly as I described through this sort of bonus and buy mechanism. But here are some of the issues and opportunities and some of the challenges. And certainly the opportunity is management's the most logical and motivated buyer. If we take the senior professionals in most A&E firms, we usually will consider them to be deserving buyers. They've helped build the firm. They're very motivated to have their turn at the wheel. They would like to have ownership. That's a natural drive in a professional service company. Problem with management buyouts is management chronically lacks cash. Very few companies have paid their people, key or otherwise, enough money that they can turn around and make an all-cash or significant cash offer for the company. And so management buyouts are often leveraged buyouts, meaning we're going to borrow money. And here's where we run into our first set of challenges. Imagine we have, and I'm going to use a very simple mathematical example here. Imagine we have a company that we think is worth about $10 million. And by the way, that probably equates to a company that is debt-free with a couple of $1 million of EBITDA. The multiples can change from company to company and from time to time, but that's going to be a rough idea. So we have a company with a couple of $1 million of EBITDA and a $10 million value. And imagine management decides they'd like to buy that from the founders. Well, the problem is we have a very highly motivated management team that raises $1 million of equity by mortgaging their houses, spouses, cars, children, and whatever else they can borrow against, they might raise $1 million, and of course, where does that leave them? $9 million short. And that means that this $10 million buyout is going to have to be accomplished by borrowing $9 million. And the problem with borrowing $9 million is we got to pay it back. And first of all, of course, no bank is going to lend us the whole $9 million. A decent piece of that is obviously going to have to be seller financing. And secondly, our problem is that we got to earn money, pay taxes in order to develop the after-tax proceeds to pay back the $9 million. And so typically, if we're borrowing $9 million, we're going to have to earn $15 million over time in order to pay back the $9 million. And if we go back and imagine our $2 million EBITDA company that has to put some money back into capital expenditures and growth, and we also have to pay interest on this $9 million, the short time frame for paying back, given the mixture of taxes, capital expenditures, and interest, you're often looking at a 15-year or longer period that we might have to take to pay back this $9 million of leverage, and that's going to be unacceptable to an awful lot of sellers as well as an awful lot of buyers. And by the way, even if we're willing to agree on that and recognize that we're going to pay a lot of taxes along the way, we're going to have a real struggle between founders and the management buyers over control. Because if I'm selling the company and taking back a lot of financing that I'm going to have in place for a long time, what's the thing that I want most? Probably adult supervision. And if I'm a buyer, mortgaging everything I own and putting up everything I own to buy the company, what it is that I want? I want control sooner rather than later. So both the finance and the control aspects tend to undermine these kinds of leveraged management buyouts. We can take the approach I described earlier. Let's just keep paying management bonuses and they'll keep buying stock. But this is going to take an awfully, awfully long time to shift a lot of ownership once a company has become valuable. And if we're dealing with a company worth $500,000 or $1 million, this will work just fine. If we're working with a company that's worth millions upon millions of dollars, this is going to take an awfully long time. And it's also tax inefficient. We're taking $1 of company revenue, we're handing it to an employee as a bonus who's paying most likely at around the 40% combined tax rate to net 60 cents, and they're now handing it to a shareholder in exchange for stock, and the shareholder is taking the proceeds, paying taxes on the proceeds. And what we probably have effectively done is turned $1 of corporate revenue into 45 cents in the hands of an individual shareholder, or in other words, we've really made the government essentially more than half partner in our cash flow. And that's my definition of it's great for solving federal government problems, not so great for solving company problems. We then move on, in redemptions and buy sells. This usually is when we've got shareholders at different levels of seniority involvement. We have issues about how to negotiate price, how to fund it. We have the same tax and finance issues as management buyouts. If we've got a 40-year-old, a 50-year-old, and a 60-year-old, we may be spread out enough that this works. The bite isn't too bad, the tax issues aren't too bad, and we have some ability to sock away the money. A 60, a 57, and a 55-year-old, this is going to work fairly poorly. We're going to have the last person standing is going to be at a real disadvantage taking on all the leverage to pay out his or her slightly older partners. And finally, we get to the world of ESOPs. And to give before we get into the more technical discussion, the good news we'll hear about ESOPs is they're very tax efficient. We really are going to use dollars that aren't going to be taxed at a corporate level and may not be taxed at a shareholder level to do our buyout. We're going to have a process that's very much directed and controlled by the existing shareholders, where we can manage all of the control and transition issues in an orderly fashion. And our downsides, as you'll hear in the discussion, are first of all, ESOPs are complex. There's lots going on. You have to listen to folks like us as disembodied voices on webinars to learn more about it. And secondly, ESOPs function in a regulated environment, and that has some risks and issues. Take a quick diversion. One of the threshold questions for looking at whether we can do an ESOP for an A&E firm is going to be the ownership rules that may apply in different states for professional corporations and for professional operations. Each state has its own ownership and licensing requirements. They're very different. They're even often different for architects versus engineers. By the way, the rules are generally a little easier on engineers than architects. And in some cases, the ESOP's ownership matters. In some cases, it doesn't. Lots of states say things like 51% of the stock, or in some cases, all of the stock has to be owned by licensed professionals. Some say so directly. Some will attribute ownership within the ESOP as long as the participants are licensed professionals. Some states don't have much in the way of rules at all, particularly for engineering firms. I'm going to cite Pennsylvania's rules just as an example, which is basically saying that we have to have 2/3 of the direct share ownership in the hands of licensed professionals for architectural firms. However, if we're an engineering firm in Pennsylvania, if we incorporate as a professional corporation, we've got ownership rules. But as an engineering firm, even with providing licensed services, we can incorporate as a regular corporation, and we don't have any ownership requirements. Indeed, if I were ambitious or foolish enough, depending on your point of view, as a non-licensed person, I could go out and buy an engineering firm. Could not buy an architectural firm. And here's some, then we have a few common techniques we try and deal with to deal with this. And first question we always ask in any jurisdiction is if we've got a state law we don't like, does it apply only to corporations incorporated in that state? Can we incorporate in another state and get around it? That's often a possibility. Secondly, if we don't have a lot of licensed or restricted work, meaning we're doing a lot of different things or only a small part of the work we're producing is stamped and licensed and a lot of it is more general, less particular, can we set up a separate operating corp to deliver the licensed services, stamped drawings, what have you, and set up a larger, and have our larger entity be a non-licensed, non-regulated company with perhaps some agreements between them? The more elaborate view of that is to set up management corporations where we have a licensed practice that has an operating agreement with a corporation that includes all the non-licensed employees, and basically the profitability more or less flows to the non-licensed entity as opposed to the licensed entity. And finally, we can look for special state rulings. We can go to the states, and sometimes they have a process where you can either get particular letter rulings or the like, blessing a particular approach. So these are all things to look at, and look at in particular jurisdictions if the state laws in your particular place are creating problems and aggravation. Pause a second. Questions, comments so far? Anybody want to chat anything in here that they want addressed particularly? And hearing none, we will keep on going. And now what I'm going to do is talk specifically about ESOPs and how they work and how they apply here. I'll still take questions if any come up here. ESOPs, of course, are employee stock ownership plans. They are qualified deferred compensation plans under ERISA and the Internal Revenue Code, similar to profit sharing and 401k plans, designed to invest primarily employer stock and can be leveraged, which are the two unique attributes of ESOPs. I'm again getting a message of a copy of the slides. I assume these are showing up if you push slideshow at the bottom of your screen. If anybody is having particular problems viewing the slides or wants a separate copy emailed to them, they should email our marketing coordinator, Alice Simons, A. Simons, ASIMONS, at sesadvisors.com, and we'll get you one out right away. But anyway, back to the presentation here. So we have ESOPs unique in that, unlike other plans, they invest primarily in company stock, and unlike other plans, they can borrow money. And what are we typically doing in an ESOP transaction? First of all, we're dealing with shareholder liquidity. How do we get money for stock held by existing shareholders who are seeking liquidity? This is often dragging along, if you will, long-term succession planning. We're dealing with corporate and personal tax planning, and we're trying to deal with an ownership or partnership incentive for key people. These are the things that we're usually being asked to accomplish when we look at an ESOP. There's a set of tax preferences for ESOPs that typically motivate people to start thinking about them. This is what gets people's attention and willingness to put up with complexity and aggravation, which is the ability to save substantial tax dollars. And the four basic tax breaks for ESOPs that are out there, first of all, is our ability to finance a leveraged buyout of individual shareholders' shares with borrowed money, where we get tax deductions equivalent to the principal we pay on the loan. What does this mean practically? If we're in our $10 million company, if we're borrowing $9 million, we're going to be able to repay that $9 million leveraged ESOP loan, unlike our management buyout loan, by earning only $9 million in the future, and that's because we're going to get a tax deduction as we pay down the principal of our $9 million of loans. Secondly, we have a unique benefit we'll talk a touch more about in a minute, which is the ability of shareholders in a company that is or becomes a C corporation to indefinitely defer capital gains tax on the sale of shares to an ESOP. We'll talk about those specific rules in a minute. Thirdly, we have a sometimes useful benefit where if we are a C corporation and we pay dividends on ESOP shares that the ESOP uses to repay debt that it took on to acquire shares, corporation can get a tax deduction for these dividends. And we'll talk about why they're useful in a couple minutes as well. And fourthly, we have the alternate universe of S corporations, where we have the opportunity not to have anybody paying taxes on the portion of S corporation income attributed to the ESOP for tax purposes, and we'll come back to that one in a minute. Let's start out with capital gains deferral here. There is a benefit under Section 1042 of the Internal Revenue Code. It permits shareholders who sell shares to an ESOP to indefinitely defer capital gains tax on that sale of shares. This is a benefit that's been allowed under the tax code now for more than 20 years. It's the requirements for this deferral are that the ESOP must own stock that represents 30% of the value of all company stock after the sale. And the selling shareholders, the people who receive the proceeds, must purchase qualified replacement property, what we call QRP, which are stocks or bonds of any domestic operating corporation. So essentially you're getting one bite of the apple to sell your closely held stock and replace it typically with a portfolio of perhaps diversified stocks or bonds. And it's not coincidental that Section 1042 is in the same general area as 1031 because these are rules akin to the like-kind exchange rules when you sell one thing and buy another similar kind of property. So the idea is you get one transfer out of your closely held stock and into a different portfolio. And there's all sorts of sophisticated techniques for what one can do and perhaps what one ought to do in terms of buying qualified replacement property and some techniques that help you unlock the value of that, particularly since a lot of folks are concerned, well, I can get my money out, but I have to buy these qualified replacement property, and if I sell any of the qualified replacement property, again, then I'm triggering a gain I deferred. And so again, there's more discussion to be had here. It's a little beyond the scope of where we're going to go today, but there are some fairly sophisticated techniques to really avoid capital gains tax and get use of the money. Another thing we'll cover for a few moments here is the world of ESOPs and S corporations. And as we all probably know, in an S corporation, the corporation does not pay federal income taxes directly. Instead, the corporation's income is attributed to shareholders for tax purposes. The ESOP, as a shareholder in an S corporation, is a tax-exempt pension trust. And so when it gets a K-1 form from the corporation telling it its share of corporate taxable income, it essentially tosses the form. It does not pay any taxes on its share of corporate income. So if we get to the point where we have a company that is 100% owned by an ESOP, and the company is or elects to be taxed as an S corporation, we have created a fundamentally tax-free entity. We have a company that in essence is taxed at the same rate as the United Way. And so many of our clients who started out perhaps with ESOPs that own less than all of the company have gone aggressively to the idea of how do I have the ESOP become the 100% shareholder of the company. And we'll talk about some of the other implications and some of the other ideas that go along with this in just a minute. So the only price we pay is if we become an S corporation to do these things, then we get to the point where we cannot elect capital gains deferral. So perfect world, of course, are C corporations, where the shareholders sell and elect capital gains deferral, and then the day after the company elects to be an S corporation. We don't always see that perfect world, but that's often a fairly ideal way to go. So how does an ESOP work? We'll talk it in words and then probably more usefully in pictures. Company is going to establish the ESOP trust. This is the same way we would establish any kind of retirement income trust. That trust is going to purchase company stock, either from shareholders or as newly issued shares from the company. The financing for the transaction is going to come typically either from a bank, third-party lender, or perhaps from the selling shareholder. The company is going to fund the ESOP on an ongoing basis so that the ESOP can repay this debt it's taken on to buy shares. And of course, we do have what we call a repurchase obligation, which is an obligation down the line to make sure that employees who come to own company stock in an ESOP can eventually cash it in and have their own liquidity event. So we are funding first the liquidity event for the large shareholders, and many years later we may be funding a series of small liquidity events for our new indirect shareholders, our ESOP participants. Anybody want to jump in with questions on the chat? Feel free. So let's look schematically at our typical initial C corporation transaction. We're going to make a couple of assumptions here and a couple of points. One is, in our experience, most of the time, not all of the time, if a company is seeking to sell a minority interest to an ESOP, if they are an S corporation, they will very often, if not always, decide to be a C corporation for purposes of this transaction. One reason is the ability of the shareholders to defer capital gain. The other we'll talk about in a minute is the valuation effect of how we structure the stock in a C corporation versus an S corporation. And the third is how we fund our ESOP. It's a little more difficult in an S corporation than a C when we have only partial ESOP ownership. And so let's start out by imagining our hypothetical A&E company with our hypothetical couple of $1 million of EBITDA and a hypothetical couple of shareholders. And we decide that we think the company is worth $10 million. And the first question, of course, is for purposes of an ESOP, how do we know that it is worth $10 million? And the answer is, in an ESOP transaction, anytime the ESOP is going to buy stock from a shareholder, it must, excuse me, it must be according to an independent appraisal of the fair market value of the stock by an independent appraiser who works exclusively for the ESOP. So in other words, ESOPs generally are not price-line. We don't get to simply name our own price here. We must have a mechanism with an independent appraisal done on behalf of the ESOP to do it. And so imagine our shareholders say, well, we have a $10 million value company. We'd like to have a $4 million liquidity event. And so the first thing we do is we pad off to our perhaps our existing banker, perhaps a few other banks in the neighborhood. And as a company, we say we'd like to borrow $4 million from the bank. And of course, what does the bank want in that situation? They want two things. One is they want a note, our promise to pay them back. And the second thing is they want is collateral, things that they can sell and grab in the event that we don't. And of course, being an engineering firm, we may be a little bit light on collateral, perhaps with the exception of maybe having lots of receivables. And so there may be an interesting negotiation with the bank of how you're going to lend us $4 million when all of our tangible assets could be sold out on the street and we might get a couple of $100,000. We're going to bookmark that question for a moment. So we have our company now having borrowed $4 million, and that company is going to turn around and loan that $4 million to our ESOP in what we call a mirror or inside loan. And our ESOP is going to give back to the company a note, its promise to pay it back, and a pledge of the stock that it's going to buy from the shareholders. But I will mention I have a couple of questions up I'm going to get to in a moment. Thanks for sending them in. So our company has a $4 million note payable to the bank, conventional liability, has what looks like ought to be a $4 million receivable from the ESOP. Looks like our balance sheet shouldn't be badly impacted. However, under SOP 93-6, the accounting pronouncement, it tells us otherwise. It says that when we receive a note from the ESOP, well, we're going to eventually have to fund the ESOP to pay it back. We don't get to book the note from the ESOP as a receivable. We instead have to book it as a contra equity account. What does this mean practically? It means practically our balance sheet's going to be really a little bit ugly when we're done here. Do we care? Almost all of the time we don't. The only folks who are looking at our balance sheet are the banks that are financing us, and they should understand this and understand ESOPs. So our ESOP has $4 million of cash, and it's going to send it over to the shareholders in exchange for company stock. If I had you all in a room here, I'd ask my favorite trick question: how much stock does the ESOP get for $4 million? And of course, the ready answer people would like to make is 40%, because $4 million is 40% of $10 million, and my response to that is not so fast. Our appraiser is not looking only at the value of the whole company. It's looking at the value of what the ESOP is buying, and the ESOP is buying a minority interest. And most appraisers, when we buy a minority interest, are going to tell us we really ought to be discounting the value of what the ESOP is buying by something in the order of 20%. And of course, that's going to be rather unpopular with most shareholders. You know, the question is, if I've got a $10 million company, why should I sell part of it for less than a pro rata portion of the whole? This, by the way, is where our tax-deductible dividends come in. Remember, our company is going to have to give the ESOP money so that the ESOP can repay the company. Remember, I'm going to skip ahead here a slide and show this. and our company's paying back the bank. If we have a $4 million loan payable over 7 years, not too untypical, we're paying the bank, 570 some odd $1,000 a year of principal, not tax deductible when we pay from the company to the bank, and we're also paying some interest, which is tax deductible. However, at the same time, we're giving the ESOP money, contribution to a retirement plan, or a tax-deductible dividend, also tax-deductible. And ESOP's not cashing the check. Money looks like it's leaving the house twice, but it isn't. It's handing back the company the money as a return of principal. So we are getting a tax deduction for funding the ESOP, getting the money back non-taxably as a loan payment. And so this non-cash loop between the company and the ESOP is typically generating a tax deduction equivalent to the cash non-deductible principal payment to the bank. This is why we say principal is effectively tax deductible in an ESOP loan. And of course, since we're indifferent if we fund the ESOP with tax deductible contributions, or to some degree we're indifferent if we give them tax deductible dividends, if we go back to our prior slide and start to look at the transaction, we can see that we can sell to the ESOP a special class of stock that has a dividend stream attached. And of course, an ESOP can pay more for dividend-paying stock than ordinary stock. Net result of all of this, as it flows through, is that very typically our ability to use a tax-deductible dividend process attached to the stock the ESOP is buying will typically offset the minority interest discount that we would otherwise attach to the minority interest the ESOP is buying. And this, by the way, this valuation difference is probably the most common reason why many S corporations will become a C corporation to do a minority interest ESOP. It may not even be the capital gains deferral, which is nice, but at a 15% federal rate, not essential. It's this valuation difference, the ability to make up the minority interest discount by using a special class of stock, which we can only do in a C corporation. Of course, our shareholders now have $4 million. They can defer capital gains tax by buying $4 million of qualified replacement property, and this may be the solution to our collateral problem with the bank. Bank wants things they can grab and sell if the company doesn't pay them back. Often the bank and an A&E firm will negotiate to have the shareholders make a partial or a complete pledge of the qualified replacement property as collateral for the loan. It will be a limited guarantee, if you will. And in ESOP financing, unlike conventional financing where most of the negotiation is rate and term, here there will usually be a hot and heavy negotiation over the size and nature of the pledge of QRP. Let me take a quick stop here to deal with the questions. One question here is about minority interest S corporation deals. And apart from dealing with the valuation issues and the lack of capital gains issue, the question now gets raised, which I think is the other question here. In an S corporation, we have individual shareholders that need distributions from the company to pay taxes, and we have an ESOP that has to receive a ratable distribution because it's also a shareholder, but doesn't have a direct use for it. And if the ESOP receives a distribution and uses it to repay the loan, that's great, but the company's not getting any tax deductions for funding the ESOP. And so anyway, as this questioner, I think, rightly points out, it gets downright complicated and often unpleasant in minority S corporation ESOPs because of our need to continue to make distributions and the discomfort of many companies and owners about the implications of having to make a distribution to the ESOP as well. And then there's another question here that asks, do all employees have to participate in the ESOP? The simple answer is no. The practical answer is yes. There's no requirement that says everybody has to participate, but we have some rather challenging non-discrimination rules that as a practical matter leads you to the point of view that pretty much in most all ESOPs, most all employees are going to participate. So moving ahead, we've covered the ESOP loan repayment. I want to talk a little bit about initial S corporation ESOP transactions. And these transactions, typically, our goal is to go from 0 to 100% ESOP ownership in one fell swoop. And so the demographics of our first transaction are typically somewhat younger shareholders, owners who are looking for slow and gradual transition, and so they're selling a minority interest, and those folks are often 45 to 60 would be the main line, although I have a 95-year-old shareholder who's still thinking about it. But the demographics here for selling 100% of the company are a little bit older. These are people 55 to 70 who are looking for a more complete transition. Goal here is to end up with the ESOP as the 100% shareholder and to end up being an S corporation so that we really aren't paying any taxes. And in these transactions, we still may be borrowing some money from the bank if they'll lend it to us. And typically, we're using it, the company is usually buying back all of the stock from the shareholders because we do not need tax deductions for funding the ESOP. Company may be separately selling the stock to the ESOP in exchange for a note. This gives us control to allocate the stock over a long period of time, and it takes the shareholders out of dealing directly with the ESOP and dealing with all of the regulatory issues around that. However, of course, to get the ESOP 100% ownership means giving the shareholders 100% fair value for their stock. Very rarely are we going to be able to borrow that entirely from a bank or third party. As a matter of fact, I'd sort of submit to you if a bank or third party would lend us 100% of the proposed value of the company, we've probably undervalued the company. And so therefore our shareholders are going to be taking back some of the financing. You know, one of the first things one would hear from any group of professional advisors is, please, please do not, take back financing. That's a bad deal. You're going to usually get a note with a very poor return and, no rights to control what's going on. And so why would one want to take back financing? And when we do these kinds of transactions, we're going to look at the subordinated debt that the shareholders are taking back, and instead of, viewing it as a, poor instrument, we're going to structure it the same way a third party would structure it if they were lending money on a subordinated basis. And what does a subordinated lender want? They want a higher rate of return, representing fair compensation for the risk, often, between 10 and 18% total return. And they want a bunch of control features so that make sure the company pays them back and they can control the company in the interim. So these subordinated notes will often have a relatively low rate of fixed interest, 4, 5, 6%, but will have warrants, which are essentially stock options attached to them with a relatively low strike price, and therefore the ability for the shareholders to participate in the growth of the company to give them additional return. And then also, of course, we'll have some control features attached to the subordinated note. So the short strokes here are we can structure this so that the shareholders are getting a mixture of cash and notes for their stock, but the notes really have a fair value to the shareholders such that they're not being disadvantaged by taking back the financing. And that fair value is the ability to control the company to a significant degree in the interim and an enhanced return attached to the control features in the note itself. So if we look at, what's a typical vision here, one vision is we're going to do several 1042 transactions, perhaps C corporation transactions, to sell most or all of the stock ownership to the ESOP over a period of time. And we'll use some options or phantom stock equity for key management that will eventually get them some degree of what we call synthetic equity or economic value outside of the ESOP, and will eventually make an S corporation election. And the ones that don't make S corporation elections are ones that have other significant issues, mostly companies with a lot of cash or cash basis for tax and have a lot of receivables, and where the cost of the S election is greater than the benefit of being 100% ESOP-owned tax-free entity. Another vision is this purchase of all of the stock from the existing shareholders. We may have a warrant overhang in connection with the subordinated notes. We may have warrants for 15 to 30% of the company out there. We may also have options or phantom stock equity or stock appreciation rights for key management that also give them 15 to 30%. But now we are a tax-free entity, and we can use that to accelerate our debt reduction and the financial operation of the company. Let me detour and take a couple of the questions here. One question is, stocks or bonds of any domestic operating corporation. That can include preferred stock as long as it's a qualified. There's a longer definition of qualified operating in terms of a domestic operating corporation, but if it's an operating company, preferred under that definition, preferred stock is okay. And next question is, if we're going to use a special dividend paying class of stock, how do we get this shareholder, the special class, before the transaction? And the answer is we're going to do a recap, and we're not going to give them value that the other shareholders are not getting. Imagine that we have 3 shareholders. Each owns a third of the company, and one shareholder wants to sell. What we're going to do is we're going to have that shareholder exchange their 33% common for something that might be, by example, 25% convertible preferred. It has a dividend right, which enhances value, but it has a right to less of the common underneath it, so that the ownership on full dilution to the non-selling shareholders will go up a little bit, but the selling shareholder will be selling a dividend-paying stock to the ESOP. And I can handle this in more detail offline to the person who's asking it, but that's generally the mechanics. A couple of quick executive comp concerns here. My slide would like to advance. Which is, we're dealing with some tough issues very often, particularly in A&E firms. We need to reward our key people. Our key people often want direct ownership but can't afford to buy it. Our owners often want cash for their holdings, but the key people can't afford to pay it. And we need a bridge between ESOP, which is broad ownership, and the key management expectations. We're getting to that bridge typically by using synthetic equity, which is dilutive, but usually dilutive of the ESOP after the fact. And we're using stock appreciation rights, stock options, phantom stock, and the like to do it. But we've really got to come up with scenarios that make sense to all the parties. Again, from the owner-shareholder point of view, the sticking point is making sure they get fair value in some recognizable time frame. And from the key management point of view, the question is, do they get enough ownership and do they get enough control over time to meet their expectations? And these are often highly negotiated, highly discussed, highly worked out in A&E firms. So in an ESOP transaction, we have a couple of things we've got to take care of. We've got to look at valuation, got to look at financing. We've got to deal with the ESOP and the benefit structure, got to deal with legal and fiduciary risk, and we've got to deal with cost and complexity. Quick walk through valuation has to be done by an independent appraiser. Typically, valuation is fundamentally based on expected cash flows and adjustments. ESOP valuation is done from a financial buyer perspective. We often are dealing with discounts for minority interest / premiums for control. We have marketability discounts because we are a privately held company, and we're very often looking at dividend-paying stock to manage a few of these valuation issues. Steiker's back of the envelope way to look at things here. typically the total value of all of our capital is some multiple of EBITDA, earnings before interest, taxes, depreciation. The multiples that are out there for most A&E firms are somewhere between 4 and 7, depending on quality, growth prospects, other issues. There are exceptions at both ends of the spectrum. But if you take a multiple of EBITDA that you think is appropriate in that range, you're then going to subtract the outstanding debt of the company, and then you're also going to add back in the value of the assets owned by the company that really aren't used in the business, such as cash value of life insurance would be an important one. Marketable securities would be an important one. There's obviously a bunch of subtleties here about growth prospects, risks, effective working capital debt, which may or may not be fully subtracted, what the underlying asset bases are, what else is going on in the company. But these are at least ways to start out thinking about valuation. Thrown out here also now a few key metrics out there for A&E firms. And one of the things, I would say that in our experience, it's often the case, the valuation for A&E firms seems to be, seems to center very often somewhere around half of revenues, sometimes a bunch lower, sometimes higher. But that follows the fact that a lot of these companies are dealing with, EBITDAs that are in the 8 to 10% of revenue range, and the multiples of those EBITDAs are in the 5 to 6 range. And these, again, are very rough guidelines to start thinking, not conclusions that one should base their planning on. ESOP financing quickly. Keys are cash flow and collateral. Collateral is obviously the key concern in professional service firms. You want to be very careful about using short-term assets, i.e. receivables, as collateral for long-term debt for these transactions. That's not a don't do it. It's look carefully at it and look at working capital needs. And banks are typically looking at debt service coverage ratios, minimum 1.3 to 1, 1.5 to 1 often required. And that's a reference to EBITDA relative to principal and interest required to be paid on debt. That's your most basic debt service coverage thing out there. Total debt to EBITDA, banks right now, high end right now is probably 3 to 1. There's some looks if you have a lot of working capital financing. There's not a lot of air balls in the marketplace right now, and those are coming down. Lenders love QRP because that's collateral they can sell right away that's marketable. Rates out there, broad range LIBOR plus 150 to 300. We saw some lower rates at the frothiest moment in the financing world in the last couple of years. Haven't seen much be higher than that. Where are we going to get our financing from? We're going to get it from usually our existing banks, other commercial banks. The brokerage houses these days are lending money, seller financing, and specialty finance groups, which are the legal variation of people, at least in our city down in South Philadelphia on street corners, who will loan you money at very high cost. Not going to cover much right now in ESOP plan design, other than to say that the rules for ESOPs generally mirror the rules of other qualified plans. We have to cover broadly pretty much all employees. The benefit is usually going to be allocated according to compensation. We can use other methods as long as we can show those other methods do not benefit highly paid people more than our mainstream method here. We're going to have vesting schedules same as other maximums under ERISA, which is to say a 3-year cliff or a 6-year scaled vesting, 20% after 2, 40 after 4, 60 after 5, 80 after 6, 100 after 6, 80 after 5, 60 after 4. I still got the old schedule in my head all these years. Benefit distributions, when do people get to the pay window? In an ESOP, we have some special requirements. People who leave death, disability, normal retirement, we're required to begin giving them access to the value of their stock beginning a year following when they leave, and we can take up to 5 years to pay them. People who leave pre-retirement, we can make them wait for 5 years and then again pay them out over a 5-year period. Voting of ESOP stock. ESOP stock is held in trust for the benefit of employees. There is a trustee. Trustees can be insiders or outsiders. Larger companies typically use outsiders. Smaller companies may use insiders. We are required to let employees tell the trustee how to vote their shares on major corporate change issues such as merger, dissolution, liquidation, recapitalization, reclassification, and the like. We are permitted but not required to let the participants tell the trustee how to vote shares for election of the board of directors. What are the steps in a transaction? First step typically is a feasibility study. Question usually is not whether you can do an ESOP. Most anybody who wants to do one can figure it out. Question is whether it makes any sense, how it fits relative to the goals of the company, and what's the best possible roadmap we can construct to do it. If we have a roadmap we all agree on, we have to go find financing. We have to deal with the independent appraisal. To deal with plan design, we have to kill a whole bunch of trees to get to a closing. Only government approval we have is after the fact. We submit our plan document, not our transaction documents, but we submit our plan document to the IRS for its blessing, which is pro forma and automatic. On an ongoing basis, what do we have to do? We have to update our appraisal annually so that we know what the value of the stock held by the ESOP is each year. We have annual record keeping and administration similar to other qualified plans. We may have to eventually plan for repurchase obligations as our plan matures and people leave and become entitled to distribution of benefits. We have to deal with communications. What are we going to tell people? How are we going to train people around the ESOP? And of course, every once in a while, the government changes the law on what we kindly refer to as a Lawyers Relief Act. And so we have to deal with legal compliance. Last thing I'm going to cover here is a couple of generic things about this in our experience, which is there are more ESOPs in A&E firms than probably any other industry in the company. Nearly 40% of the ENR 500 have ESOPs. I've got literally dozens of engineering firms, A&E firms that are ESOPs. Their size and scale is all over the map. There's no one way, one size fits all approach to this. And whether or not to do ESOPs is really a function of the vision of the shareholder founders. Where do they want to see their company end up? What are their financial goals and issues? What are their organizational goals and issues? Appreciate you all sitting through an hour of the presentation. Anybody has any questions, feel free to follow up directly with me either via email or telephone. Be happy to answer more questions as we go, and wish you all luck in all of your ESOP endeavors. Thanks much. Bye-bye.
Thank you. Please stand.
Premiumbeat.com